It's a crisis alert. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, panic just hit the top levels of the Biden administration as the unimaginable just happened. And what I want you to understand is President Biden has one job between now and the November elections, and that's to keep the economy intact in hopes to convince voters that 4 more years of a Democrat in the White House will be good for their wallets. But as you're about to see, the unimaginable just happened. Now let's head over to Bloomberg, where he picked today's story up with a headline: as Fed's favored price gauge rises at a mild pace and spending holds up. And while the headline looks good, wait till I show you the details. The so-called core personal consumption expenditures price index, which strips out volatile food and energy items, increased 0.2% from May. From a year ago, it held steady as it did last month at 2.6%. And keep in mind that the personal consumption expenditures is the Fed's preferred gauge of inflation. While you and I look at the consumer price index, they're focused more on the personal consumption expenditures. And so this is why, of course, the markets are fixated on this as far as trying to determine policy direction. Inflation-adjusted consumer spending rose at 0.2%, while May's increase was revised higher, giving some indication that inflation is indeed starting to cool slowly and the economy is holding up. But wait till I show you what's keeping the economy intact and why it's not going to last much longer. Friday's report offers some encouraging evidence that the Fed's tightening campaign is making its way through the economy without causing too much damage. Well, and damage we know shows up very quickly. While officials are widely expected to keep their benchmark interest rate unchanged at a 2-decade high when they meet next week, investors are betting the first rate cut will come in September, and that's highly likely given the path that we're seeing here of inflation. And this is what the Fed wanted evidence of, is that it's continuing on its downward path. And we've heard Fed Chair Powell say that he doesn't need it to get to target. He just needs to be convinced that it's going to get to target, which suggests that September's on track, particularly so as we're about to find out the economy's just not going to hold up until then. From the Fed's perspective, cumulatively, we think the data shows enough progress on both inflation and labor market conditions. Well, that's not exactly true, but it does open the door for... From the Fed's perspective, cumulatively, we think the data shows enough progress in both inflation and labor market conditions for policymakers to open the door to a rate cut in September. And given what we have just seen out of course, the global manufacturing PMIs, even here in the U.S., which is indicating a further slowdown in the manufacturing sector, which is leading to fewer hours worked and more people hitting the unemployment line, you can bet a lot of these regional Fed presidents will be pushing for some sort of cut by September. But there's one thing you shouldn't be cutting, and that's your budget for trading, because our subscribers are making a ton. Now, yesterday I showed you that this trade was headed even higher. If we go back to July 11th, we told our subscribers to buy ITB at market open. And here's what's key. While a lot of other people promote things, they tell you you can duplicate their strategy, but people, you can't do it. But ours you can, because we tell you exactly when to buy and what the stop loss levels are. Here you can see this trade's been on the books only about 13 business days, and guess what? It's headed higher even today. And how do we get returns like that? Well, we look at discrepancies. When the machines that trade large amounts of money move into deep short positions and price moves against them, they have to short cover, and that flags on our reports. But maybe you don't like to trade with machines, even though we know you can beat them, but you like the technicals. But the problem is you find yourself getting in late and out early. Well, the way you beat that is, one, you run a proprietary overlay on the signals. But look at this, on a 1-month, 3-month, and 6-month period, we run momentum signals. So when momentum pulls back and then it shifts, well, that flags on our momentum timer pro report a buy. But here's the great part. You get the daily reports, depending on which one you want to sign up for. The reports give you the tradable signals, and then I review each and every trade and give you my opinion on the ones you should do. I tell you what your stop loss levels should be. I give you a tracking and update of the returns, and we review every stop loss level on the weekends Best part all, you get a 30-day free trial, and we'll show you how you can take advantage and get the same returns. Here's just a snapshot of what our subscribers see. They see the reports, they see the recommendations, and now we talk about other reports. This one showed inflation adjusted outlays for services and merchandise each rose 0.2%. And look at this, housing and utilities, no surprise as we head into the summer months, it gets hotter, utility bills going up led increases in services spending, while vehicles and recreational items propelled in advancing goods. But signs of cooling in the labor market are starting to translate into less purchasing power. And this is an issue we've been talking about on the show for a considerable amount of time, that the labor market is key and slowly grinding to a halt. It's starting to come undone, and this is a massive problem. But this isn't the underlying issue to this report that I wanted you to see. As wages and salaries rose 0.3% in June, half of the month's prior pace. And on inflation-adjusted basis, disposable income growth slowed to 0.1%. So now we're starting to see the effects of what happens when people get on unemployment and they stay there, and that is that employers realize that they don't need to give out big wage increases because there's an ample workforce that's idly standing by, ready to take that job, potentially even at a lower pace or wage, that is. And so here we can see average hourly earnings of production and non-supervisory employees multiplied by average weekly hours to give us, of course, what's called total compensation. That showed in blue on a year-over-year rate of change. And you can see that as total compensation growth slows, what happens is it's slowing because there is an inventory. You think about it from an inventory perspective of workers on unemployment that would like to have a job. And as more people get on unemployment and stay on unemployment, well, employers are not pressured to give out the hours or the wage increases that they used to do. We see that effect over and over, has particularly headed into recessions and financial crises. And look now, what do you see? A continued downward trend in total compensation, and we're seeing just the early stages now of a beginning increase in continued claims that we talked about in yesterday's show, that if this continues to rise, it's game over for the U.S. economy. My current prediction is by the time summer ends, we're going to see more people hit the unemployment line, and it's not going to set up what the Democrats want for the November elections at all. But here is the shocking part of the report, as the savings rate fell to 3.4%, the lowest since December of 2022. This suggests that consumers have less firepower to ramp up spending in the coming months. That is perhaps the wrong way to look at it. Think of it this way. If more people are hitting the unemployment line and price growth is not coming down at a level fast enough where the Fed wants, what this means is that consumers cannot keep up with higher prices. So when that happens, how do they maintain their lifestyle? As they dip into their savings. And that's what we're seeing here. And this is a huge red flag for the economy. Particularly so that the Philly Fed report published earlier in the week showed credit card delinquencies are on the rise. And this has everything to do with the fact that consumers cannot keep pace with higher prices. And look what happens when we see a rise in delinquencies. Here you see that in red of the delinquency rate on credit cards against the personal consumption expenditures. And this is the core. So we're going to strip out food and energy here to show the things that consumers absolutely need to have. Now, granted, they do need food and energy, but due to the volatility of them, we're going to look at this without that. And what happens is consumers hit delinquencies. What that means is they don't have enough money to pay on their debts on time. And what that means is they don't have enough money to spend in the real economy. And you can see personal consumption expenditures come down, which means we know for a fact the Fed is going to get to its target. Problem is it's going to go right through it to the downside. Here you can see a continued rise now in credit card loan delinquencies is going to lead to a further decline in personal consumption expenditures. And as demand goes down for spending, well, that means, of course, more people likely to hit the unemployment line. But for the moment, it means consumers are tapping their savings accounts. But this isn't exactly really good news. You can look back to periods, say in 2000, where you see a slowdown in savings rate actually did lead to a rise in personal consumption expenditures, which is what you'd expect to see, that as people draw down their savings, it leads to more spending, as the article suggested. But then all of a sudden, consumers had a problem. They hit a wall. The economy didn't keep up. And then you see personal consumption's expenditures tumble. Now we fast forward heading into the global financial crisis. Once again, consumers are draining down their savings, but this time it's because they can't keep up with higher prices. Next thing you know, they run out of money again, and there goes the economy. This time, this is the issue. While price growth is slowing, it's an indication that consumers are being forced to tap their savings and they're not able to keep up, as evident by the delinquency rate in credit card loans. And there's further evidence this is happening because this occurs when consumers, you see that the cost of goods is more than their income, and well, we have data on that too. Here you see personal consumption expenditures in blue against the personal income rate in red, and based on data that came out today, what you can see exactly what's going on with consumers is their incomes are not keeping up with inflation, forcing them to tap their savings. It becomes only a matter of time before the savings rate gets so low, before savings accounts get depleted enough that they quit spending, which is exactly what the University of Michigan flagged today, as we note that consumer confidence now plunging. And depressed Democrats drag University of Michigan consumer sentiment survey to the 8-month low. Of course, we assume that in 2 weeks when we get in the next preliminary one, that will change potentially. And here we can see this is again the weakest since December of 2022. As we look at current economic conditions, current sentiment, and expectations, that one looks out forward about 6 months. What you can see is it's plunging. And we've seen this happen, but then it quickly turned around. And we noted last time we saw the report that if it continued its downward trend, it's game over for the U.S. economy. And let me show you why. Because there is a strong link to confidence and spending. As we look at personal consumption expenditures, you can see periods where they are rising and then they start to slow down. And what happens? Consumer confidence goes with it, because when consumers lose confidence in the economy, their wallets tighten up. And this is, of course, a big danger flag for the Biden administration. They need confidence to stay elevated. They need people to feel good about the economy if there's any hope, of course, of keeping Democrats in the White House. But weigh in the comments below what your opinion on that is. Do you think the economy matters? Do they win either way? Or does the economy all about what people vote for? Let's take a look here, because we can note you see periods of confidence again rising, and then it falls off. What happens? Spending goes with it. You note that happened here again headed into the pandemic. We note that, of course, confidence started to slow down. Of course, spending slowed. Now we're seeing a huge decline in confidence after a big rise, which suggests, of course, people were confident the economy was going to turn around, but it wasn't matching their spending. Now all of a sudden they're realizing the economy isn't going their way. And you see the evidence of this in the personal savings rate. When the savings rate is not growing, that means, of course, consumers are tapping their savings. That means confidence eventually starts to head lower. Now you see, of course, the savings rate here in blue. And every time we head into a recession, you know it doesn't increase. Eventually that leads to a decline in confidence. And now we're seeing that happen again. The savings rate being drawn down. Consumers now less confident about the economy. And that's a trend that's unlikely to change, because when we look at buying conditions for houses and vehicles and large durable goods, well, they're plummeting. How about this for houses? Now new all-time low here based on going back to the 1980s. Vehicles going down, durable goods, that falling as well. Consumers showing they're completely tapped out, and that is not a good sign, because we can then look at advanced retail sales shown in blue. This on a year-over-year rate of change against the University of Michigan Consumer Sentiment Survey, and sure enough, you see the direct link. As consumers lose confidence, they spend less, and the economy then heads into a recession. It's now becoming a foregone conclusion of where we'll be. The question is for the Democrats who are trying to keep the White House. Will the economy hold up long enough? Will the market hold on long enough? Well, Bank of America says not a chance. As B of A says cooling economy will crack big tech rally even more. And the strategist who's bullish on bonds, this is Michael Hartnett, for the second half of 2024, has said signs of an economic slowdown will fuel rotation into stocks that have lagged behind the pricey tech mega caps this year. In a note today, Hartnett said that recent data suggested the global economy was ill. That's a very generous statement. And that we're one bad payroll away from big tech stocks losing their dominance. And boy, he is absolutely right. If we take a look at continued unemployment claims in red against the NASDAQ 100, what you see as more and more people hit the unemployment line and stay there, well, it does not bode well for the U.S. equity markets. And while the stock market is mega bullish, the real economy is telling investors they're about to be trapped in one of the biggest bubbles in history. And the bank's custom bull and bear indicator edged up to 6.9 in a week through July 4th. This is now the highest in over 3 years. A reading above 8 would flash a contrarian sell signal, which can be triggered if fund managers' equity allocations rise and cash levels decline further, and a rally in the laggards leads to an improvement in market breadth, this according to Hartnett. And sure enough, we know that, of course, it comes all the way back to sentiment. You can see periods of major market declines or bear markets are often led by a decline in sentiment. Here you see a University of Michigan survey in red leading the U.S. equity market, here in blue shown as the NASDAQ 100. This time you can see that move higher in equities was boosted by people being confident in the economy. Now, as their confidence erodes, look for the equity market to head into what could be now the early stages of one of the biggest bear markets in history, as we come off one of the biggest bubbles in history on the back of a globally synchronized recession. And now it starts to make sense why there's crisis in the White House. The economy is not going the direction they want, as we're now only a matter of months away from the next presidential election. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.